Just go for it.
This is Tips on Trading with Stephen Story once again. I'd like to talk with you today about fast market policies and fast market policies and margin call policies. Now those are somewhat interrelated. The reason for it is because when you have a margin call policy which is tighter, and that is usually determined by your broker and often determined by them because of the type of account you have, whether you have 100 to 1, 200 to 1, 300 to 1, 400 to 1 leverage, or the contract size, whether it's a $10,000, $100,000, or $1,000 contract size or lot size. Your broker, if he's taking the counter position against your trade, the counter trade, and you should know that he does that by now, okay? I hope you know that, because if you don't, you're in trouble. You need to know the incentive of your broker. He's taking the counter position, and he's going to protect his interest. He protects his interest through a myriad of different tactics on that side of it. One of those is creating a margin call policy that is a little tighter. Now, a broker might tell you that that's to protect you, so that if you ever do run into a margin call policy, you're still going to have more of your account remaining. But it also benefits the broker in so much that it prevents traders from being able to leverage their accounts very highly. I mean, to trade high percentages of their account successfully. For instance, if you trade 30% of your account and you've only got a 50% margin call policy, that means you only have 20% free margin remaining in your account, and you're actually trading about 65 to 70% or more of your available margin to trade. So understanding your margin call policy is vital. You should talk to your broker about it, read your contract with them carefully so you know exactly what type of margin call policy you have. Now, another reason why that's so important is because most brokers have some type of a fast market policy. The fast market policy is designed so that when the market begins to move a little quicker, the broker has an excuse to be able to lock you out of a trade, even if in some cases lock up your trade account so that you can no longer exit, you can't enter, and you can't hedge. I learned this experience the hard way several years ago when I was trading the euro, and the bomb blast went off in London in the subways, and it was about 3 o'clock in the morning my time, and within a few minutes my account was margined. I lost $23,000 because my broker put up a little padlock on the screen when I tried to close my trades, and he locked up my whole account. I couldn't get out of my trades. He wouldn't let me hedge them either, and I did that 3 times in a row. It took about 20 or 30 seconds before I could get back and try again to close my trades out. All the while, the fast moving market is carrying me in the wrong direction, and I'm losing my account. Literally, brokers will look to their own interest under those conditions. You need to be prepared for that. You need to know what your fast moving market policy is with your broker. You need to also know exactly what your margin call policy is, so you know what kind of free margin you have available, and you also need to know what percentage of your trade you've entered into the market, so you know what type of free margin you have available still once you've entered that trade. Be conscious of those things, ask your brokers about them, and make sure you get the type of policy you need. This is Tips on Trading with Stephen Story.